Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and today we have a lot of information to go through. We're going to go over the three stocks that I'm picking in this video, the three stocks you should be buying for August of 2020. Now, first of all, those of you that know me, when I pick out stocks, I don't just pick out stocks willy-nilly. Any stocks that I didn't think anything about, I didn't just pick these out of random or based off of other people or what their opinion is. I truly believe in these companies, and one of them I already own, and one of them I'm considering owning. So I'll go ahead and spill the beans. The three stocks that we'll be going over in order. First of all, we'll be going over Beyond Meat. This is a extremely high growth company. This is not one for someone to have weak hands on. This is for someone that is a believer in the company and is willing to get a huge potential if this works out. We'll be going over their annual report, their balance sheet, their income statement, the basics about the company and what they do, and then next we'll be going towards Cheesecake Factory. So I actually have seen this recently around the YouTube space, and I know that Cheesecake Factory is not one that I would typically look for, but strictly on a valuation basis, the Cheesecake Factory is looking incredible. So we'll be going over some of the financials behind the Cheesecake Factory, the direction that they're moving, and how they're handling this recession. And then last but not least is a company that I made an entire video dedicated towards. WP Carey and Store Capital, and both of those stocks were absolutely incredible. I own both of them. I own WP Carey right now, and basically I'll go over the reasons why this stock is incredible, even in the worst of scenarios, and how they're thriving in this recession, and I think that they are extremely undervalued. So we'll be going over WP Carey, their dividend history. They've already raised dividends twice in 2020. Yes, not once, but twice in 2020. They raised it quarterly, and they've kept that up even through the worst of recession. So all three of these stocks are three that I recommend. And those of you that aren't familiar with me, just to give you a quick idea of what I do, I am a dividend investor. I track my annual dividend income, my monthly dividend income, and my portfolio value. So those of you that are interested in getting signed up with M1 Finance, I do have a referral link posted in the description. And in the description, there's lots of other things in there as well, not just including my M1 Finance referral link. So go ahead and check that out, and I'm sure there's some stuff that you'll be really excited to get into. But basically, if you go ahead and use this referral link for M1 Finance, you'll get $10 just for signing up, and we have 16 people signed up, so go ahead and be the 17th person to sign up, because that would really mean a lot to me. But anyways, at the end of the video, as always, I will give you guys an update on my portfolio, and I will show you my position in WP Carey, which is very new, so I'm still pretty close to break even on it. But my position in WP Carey is down 3.9%, so it's about what I bought it at, and that's on a money-weighted return, not a time-weighted return, so yeah. But yeah, at the end of the video, I'll give an update on my portfolio, but let's go ahead and jump straight into Beyond Meat stock. So first of all, just to give an extremely basic idea of what their company does, they provide plant and, assumingly in the future, lab-based meats. So I know right now they're working more on lab-based meats, and it's more of something that's in development. It's not really something that's really focused on sales. But Beyond Meat provides products that are plant-based. They have no meat in them, and you can read the statement right here off of their investor relations page. Our products. Imagine your favorite meaty dishes like burgers and tacos delivering the juicy, delicious taste you know and love, while being better for you and the planet. That's the future we're working to build. Click below to learn more about each of our products and discover the future of protein today. This is just an example. They have Beyond Meat Classic Breakfast Sausage, and then they have Spicy Breakfast Sausage. They have the Beyond Meat Burger, and then there's tons of other products that they have, and then you see these at Walmart a lot of times if you ever go inside of a grocery store. I see these Beyond Meat Cookout Classic Burgers. They've also worked on other things like Beyond Meat steaks and other things like meatballs and also brat sausages and hot Italian sausages and Beyond Meat Taco Meat and pretty much anything involving meat that you could possibly think of that can be converted into a plant-based product. But the thing is about Beyond Meat, so one thing I want to point out here, I don't care what your preferences are. I don't care if you're vegan, you're vegetarian, if you eat both meat and plants, or if you're a carnivore, whatever the reason is. If you're in the United States, you should know by now that the trend is that people are going more and more clean and more conscious about their foods. It doesn't matter if you're talking about organic, doesn't matter if you're talking about locally grown food, vegetarian, whatever the case may be, people are paying more and more attention to their foods, and this is the same reason that Amazon bought out Whole Foods. They wanted to get in the market that is going to be growing in the food category, which is going to be cleaner, healthier food. So even if you're not interested in buying this, even if you're not a believer in the product, just know that the trend in your friend and the fad is bad. So a fad is something that goes up quickly and then goes away, and the trend is a long-term growth story. So with Beyond Meat, the long-term growth story is people are going to get more and more vegan, more and more vegetarian, whatever. Now, the one reason that I really love Beyond Meat is the numbers. Forget their mission statement, forget the products that they offer. I don't care about that. Let's look at the numbers. Let's let the numbers speak for themselves. If you don't believe in this company at all, I'm sure these numbers will change your mind. So this shows the last 4 years of their statement of operations data. Their net revenues, these four numbers on the first line are the ones we want to talk about. So these numbers are in thousands. So basically, there's 3 zeros behind all of these numbers. So that says 16,000. That means 16 million. So 2016, they had 16 million in revenue. Okay. 2017, they had 32. Okay, let's stop right there. 16, 32. That's almost exactly a double up of the previous year. Wow. Okay. 32,000. Let's go to 2018. 87. Over a double up. What? Over a double up from the previous year. Okay, well, what about today? Let's get to the most recent year, 2018 to 2019. 87 million to 300 million. That's over a triple up of the previous year. You're looking at a stock that for the last 3 or 4 years has had triple digit revenue growth. I know a lot of people like to focus on a lot of high growth stocks like Shopify and stuff like that, stocks that have absolutely went to the moon. If we type in Shopify, SHOP here, Shopify is a stock that in the last 5 years is up 2,431%, and they do not have triple digit revenue growth. They have great growth. I don't know the actual number. I think it's like 30 or 40% off the top of my head. But with Beyond Meat, they tripled revenues last year. Tripled. You know that this stock actually was offered at $25 a share, and then they had to bump it up at an extremely high price, and today it's at $128. Now, it has not come back to its recent highs when it did first IPO and everybody got excited about it, but I think if you can buy the stock now in the low 100s, and especially if you can buy in the double digits in the 90s, the 80s, I think that this stock is a steal. Holding this stock for the long term is going to do excellent for you. Now, the thing is, let's say that growth slowed. So I think about the positive versus the negative in this scenario. So let's think about the good versus the bad. Let's say that I'm right, and let's say that they keep up this triple digit revenue growth. They keep on getting some excellent partners, which, by the way, they have partnerships with some of the largest corporations in the world. They're working with a deal right now with McDonald's, that's currently in the works, Subway, Dunkin' Donuts, you name it, they're with all different types of partners out there. So with Beyond Meat, if they keep that up, I think that this stock years from now will be $200, $300, $400, $500 stock in the future. Now let's think about the bad case scenario. Let's say that they stop revenue growth. Let's say that this growth slows down significantly. Instead of 200% growth, 300% growth. Let's say they only put up 40, 50, 60%. Only 50%, like I'm saying, that's horrible. At a 50% growth rate, a 40% growth rate, you're still looking at an incredibly fast growing company. So even if it doesn't pan out as quickly as I think it will, I think that the stock definitely has huge potential long term. And so you might be saying, okay, well, what's their balance sheet look like? Something that I think is very similar with a lot of these stocks. A lot of times when you have a lot of these high growth companies, they are usually unprofitable, they have horrible balance sheets, and as of the last year, this stock is now profitable. So, a lot of companies like Roku, for example, have been growing for years and years and years, but they've never made a dime in profit until the last year. And you can see they've been public for a long time. But a company like Beyond Meat is already profitable after about 1 year of being public. So let's go ahead and look at their balance sheet. Let's look at the cash and cash equivalents and the total debt. So their cash in 2017 was about 40 million. They bumped that up to 54, and then last year they bumped that up to 275. So a huge increase in cash, about 5 times. There's a lot of other reasons why they have so much cash, but if you look at their debt, it's basically stayed the same at about 30 million the last 2 years. So their cash is literally almost 10 times higher than that of its total debt. So the beauty of that is they have tons of cash to fund operations. They're one of the highest players in research and development in their category to finding new meats and new types of products and lab-based meats and stuff like that. They're researching heavily into the future. And the fact that they have 10 times the amount of cash versus their debt is an extremely healthy position. So that way they either A, don't have any debt over their head, they can grow the company even faster, or B, if they want to raise capital, if they want to issue bonds, if they want to issue more stock, if they want to do pretty much anything possible to raise cash, they can do it so easily. It will be no issue whatsoever. When you have those companies that have loads and loads and loads of debt, they have to try to negotiate to get a good deal to try to issue more debt so they can fund their operations. But with a company like Beyond Meat, they're doing so well that it will be no issue raising capital. No issue whatsoever. So basically, that just wraps up my opinion with Beyond Meat. And if you want to read further on the investor relations page, it would take too long. But basically, you can read about their statement about where they're going for the future and how they're growing, and you can see their CEO and a lot of their other information right here. But go ahead and jumping into the next stock here, we're going to look at the Cheesecake Factory. And I've seen the stock recently in the YouTube space, and I love their investor relations page. Their annual reports are so cool to look at. They have such cool photos in the beginning with their cheesecakes and their restaurants. But if we go here and we go to dividends, now this stock has been affected quite heavily from the recent recession. If we go to all years for dividends here, it was just recently cut, and that's totally fine. Now, I wanted to point something out before this recession. So let's forget the dividends for a second about how it's been cut, and let's look at the past, because COVID-19 was not something that was affected by the Cheesecake Factory by management. It was not due to negligence. This is something that they could not control. So let's think about this company if COVID didn't happen, if it never happened in the first place. I think it would be safe to say that they would keep that growing dividend, and they would probably still be a great company. Here, let's scroll all the way back. It goes back to 2012. They paid 12 cents a quarter, 14, 16 and a half, 20, 24, 29, 33, 36, and they got all the way up to 36 before they cut it. You see how it had a pretty fast growing dividend? So if you're a dividend investor, that is great, as well as some share price appreciation as well. So with Cheesecake Factory, they were looking at expanding their businesses. They did just do some things like buy out 2 different restaurants. So we read this statement to shareholders here in one of the first pages to our shareholders. As we closed out this decade, 2019 marked a period of evolution for the Cheesecake Factory Incorporated, laying the foundation for accelerated and diversified future growth. We completed the acquisitions of North Italia and Fox Restaurant Concepts, FRC, reinforcing our position as a leader in experimental dining. It is this segment of the restaurant industry where we have excelled since our founding, and where we believe opportunities lie ahead for our company. Our combined 46,000 staff members now operate nearly 300 restaurants, delivering delicious and memorable experience to our guests in the heart of our mission. They did add 2 different restaurants to their portfolio. They did just add North Italia and Fox Restaurant Concepts. So those are 2 just excellent restaurants that they're going to be adding to their portfolio, and which will more importantly be profitable and grow revenues. So speaking of growing revenues, so you can see on their second page past the cover page, they have their page where it shows their revenues, their comparable restaurant sales, adjusted operating income margin, restaurants open, cash flow, adjusted diluted net income per share, yada yada. The revenue growth you can see here has grown every single year almost, with the exception of 2017 being the one slump year, 2,101, 2,276, 2,261, so it was a very, very small decrease, and they made that up by growing that dramatically the next year, 2,332, 2,483. You see the difference there. So with the exception of 2017, they have grown revenues every single year. 2.6, 1.2, 1.7, 0.8. They keep on growing revenues every single year. You can see that the number of restaurants are going up every single year as well. 200, 208, 214, 217. 292 with the recent acquisitions. But basically, this company is a stock that is not going to be a huge revenue growth. Basically, it's going to be a steady, reliable income stream. So when we talk about steady, reliable income streams, and I think WP Carey is another prime example of this, but when we talk about Coca-Cola, Coca-Cola is not going to grow massively. They might grow 1, 2, 3%, but it's one of my largest holdings. The same thing with Pepsi. Pepsi is not going to grow 10% a year. They might grow 1, 2, 3, 4%, but they're going to be a predictable income stream with their dividends and their share price going up in the long term. So if we look at Cake stock here, you can see that their PE ratio does not show up correctly on M1 Finance. It is not updated. M1 Finance is a little bit weird with its PE ratios, but I went ahead and looked it up, and they currently have a forward PE of about 11.5. 11.5. So 11.5 times earnings in their long-term growth story. And now that they have no dividend being paid out, while that's not necessarily a good thing, it's not a bad thing either, because now they have more money to fund operations, get their balance sheet a little bit healthier. So if they want to suspend that dividend for a year, 2 years, I think that's fine. I think they'll get right back to paying dividends, as this is definitely a favorable dividend company for being a restaurant. But I think that the stock is at an absolute rock bottom valuation, considering the long-term growth story with casual dining. It's experimenting with its other restaurants as well. It's growing revenues every single year, even before those acquisitions, and the fact that just in general, I think people love the Cheesecake Factory, and their margins aren't bad as well. And I think generally speaking, there's a Cheesecake Factory by my house, and it's been pretty busy. When I go past it, it's been pretty busy. There's a lot of people there. It's very busy. I don't think that the recession is going to hit it nearly as hard as a lot of people think it will. And regardless, I don't think this is a stock that's anywhere close to bankruptcy, and I think they'll be just fine in the long term. And you can see some of their beautiful restaurants here if you just want to get an idea. You can see this is their restaurants in Gainesville, Florida. This is one of their ones in California. This is one near me in Austin, Texas. This is one in North Carolina. There's so many other different ones that you can look at, and they even have one here in Saudi Arabia. So they have some great, fantastic looking restaurants, and who would not want to eat in a restaurant that looks like that? So a lot of their stock price has not factored in the recovery yet, in my opinion. You can see that their stock has not recovered hardly at all since the recession. If we pull up the year chart here, they bottomed at about $15 a share, and today they're only $22 a share. I think that this can easily get back to a $30, $40 stock in the next 1, 2, 3 years. And honestly, if they kept that dividend, I would probably even be considered towards buying it. But the only reason I'm not going to buy it in my portfolio is because I am a dividend investor and they cut that dividend to zero. But overall, guys, I think the Cheesecake Factory is a perfect buy. And speaking of great dividend stocks, so let's go ahead and look at WP Carey here, and let's look at the snapshot of a lot of great information that you need to know about this company. So they make $1.1 billion in base rent every year. They have an average lease term of 10.7 years. So before I go any further, those of you that don't know what WP Carey is, it's a lot like O Stock or Realty Income. So O Stock is a real estate company. They own the properties and then they sell those properties to a lot of larger corporations and then get a profit every single month off the rents from them. WP Carey does the exact same thing. And their average lease term is nearly 11 years. So when they sign contracts, they're not saying, okay, you pay us for the next year, you pay us for the next 2 years. They're looking at years and years and sometimes even decades out. I know some of their tenants even go up to like 25, 28 years, something like that. So extremely long. 98.8% of all properties are leased out. So nearly every property they have, they're collecting rents off. It's not ghosted. They're getting revenues. And then they have 1,215 properties, so definitely diversified. So if one burns down, if one goes vacant, it's not a big issue. And they are also diversified between 352 different customers or 352 different tenants. And then they have 141 million square feet. And if you see here, 99% of their leases have contractual rent increases. So if we see their dividend here, how have they raised their dividend twice already in 2020 with this recession, including during June when everything was horrible and everything was already shut down? How have they done that? Well, part of the reason is they invest strictly in investment grade corporations, and all of their rents, nearly 99% of them, have contractual rent increases, which means that they raise their rents every month, every year, every couple of years, whatever. They have 38% uncapped CPI, CPI base, fixed, other, and then the 0.8% none. So 99.2% is raise their rents all the time. They have 63% of their properties in the United States, they have 34 in Europe, and then they have 2% left in other countries. But you can see how they're diversified, which is exactly how I want, primarily in the United States, but they also have about a third of their portfolio mixed in with other countries, primarily in Europe. In property type, one problem that I have with Realty Income is that they primarily focus on retail. With WP Carey, for example, you can see their stock price right here. With WP Carey, they're 23% industrial, 21% in warehouse, 22% in office, only 17% in retail, 5% in self-storage, net lease, and then 9% mixed in other. So you can see the pie chart here, extremely diversified. Not one category makes up 1/4 of their portfolio, their largest being industrial at only about 24%. And then I'm not going to go through these, but you can see the tenant industry diversification: retail, automotive, public finance, tobacco, wholesale, telecommunications, banking, yada, yada, yada. So many different industries. So if one of these industries were to go down, let's say the automotive industry, something huge happened and it took down the automotive industry, well, that's one of the biggest slices, but only 7% is gone. If maybe wholesale went away, 1% is only gone. They still have the massive part of their portfolio available to them. So with a company that is raising its dividend every single year and raising its dividend every single quarter, that is definitely one to pay attention to. It is not often that I say a dividend of 6% is safe. This is one of the very few exceptions to this rule, that it has a safe dividend of over 6%. So if you're buying the stock today and the share price goes nowhere, if it's $67 next year, if it's $66 the year after that, it still gives you a 6+% return strictly on the dividend, which will be raised. So maybe by next year, maybe it'll be up to 7%, who knows. But this stock has not recovered as well as a lot of other stocks, not as a lot of other big tech stocks, and only up 8% in the last 5 years does not give the stock justice. And I think that in the long run that this stock will do absolutely incredible. And this is one of those stocks that I probably wouldn't sell even if they cut dividends to zero, because I know that in the long term they will pay an incredible amount of dividends. But overall, guys, that's my opinion on those three stocks. If you want to own any one of these three, WP Carey, Cheesecake Factory, Beyond Meat are all three incredible stocks, and I think that it is a great decision to own any one of them. And speaking of stocks that I own, the market did just open just a second ago. We're getting closer to 2,900 in my portfolio, and like I mentioned, I will give you guys an update on my portfolio. My biggest winners here: Whirlpool, Discover Financial Services, Apple, a lot of the same names. And then I have a couple in the red. WP Carey, like I said, is a newer position, so it hasn't had time to really reflect that stock price. Store Capital, Starbucks, Duke Energy, all four of these are actually newer positions. And then if we go back here to a sorted by value, you can see a lot of my top holdings are doing fantastic. So far, my companies have done pretty good with Q2 earnings, generally speaking. If we go to my holdings here and we look at a time-weighted return, we are up $365.67, or about a 14.5% return. On a money-weighted return, we are up 20.91%, 411.43 in total gains, 385.52 coming from market gains, and then about 26 bucks from earned dividends. And we have received dividends in this order if you want to look at the list right here. But overall, guys, I will continue to buy these stocks. And as you can see from my trading, I have been buying in about $25 increments every single week, and I will be bumping that up very soon in August, probably up to $100 a week. So we'll be investing a lot quicker, and this portfolio will start growing rapidly. So hopefully we'll get some new attention towards my portfolio and towards my channel. So overall, guys, if you watch all the way to the end, make sure to use this referral link and check out the description. Even if you already have M1 Finance, or even if you're not interested, go ahead and check out the description, because there's lots of cool stuff in there. So go ahead and check that out. And if you do use my referral link in the description, you'll get $10 for signing up. So thank you guys so much for watching. Let me know what you think about these three stocks down below, especially Beyond Meat, because that's one, even not being a dividend payer, I've considered adding it. So thank you guys so much, and I will see you next time.